Hey guys, how's it going? Solo back again. It is Saturday, July 25th. It's a little after 4 p.m. and obviously it's Saturday, so the markets are closed. But I've been racking my brain trying to figure out what is the best way to play AMD earnings. So if you haven't heard yet, AMD has its earnings session Tuesday, July 28th after hours. So you have basically 2 days of trading Monday and Tuesday before AMD's earnings Tuesday after hours. And I was debating what the best strategy is in terms of being able to get the most amount of premium or the most amount of profit from how I think or how you think AMD's earnings sessions will go and how the stock will react to the earnings report. So right now, I mean, if you've been living under a rock, you've known, or you don't know if you're living under a rock, that AMD for the past 2 days has just shot up to the moon. Just taking a look at the 1 week graph here on AMD, you can see earlier in the week we were trading in the mid 50s and we closed Friday end of day near just shy of 70, right? So AMD has gapped up by almost 25% in the matter of basically 2 days. So absolute insanity. So a normal person would think, well, there's probably going to be a lot of profit taking. But I thought that on Friday, and not only did the stock not go down, it didn't even trade sideways, it gapped up even higher. So to kind of add fuel to the fire, like I said, earnings is coming up for AMD. So is the run up prior to earnings because people are assuming that AMD is going to blow its earnings out of the water? And then once that's confirmed during earnings, does that mean AMD's stock is going to rise even higher? Or is the run-up prior to earnings almost like a smokescreen? Because I found it interesting that AMD announced its new chips right before earnings, like a few days right before earnings. So are they trying to compensate for what they know are going to be bad earnings? So they're trying to, I don't want to say artificially inflate the stock price, but are they trying to create some buzz so the stock price goes up because they are fearful or they know that once earnings comes out that their stock price would have gone down, so they're trying to compensate for that? I don't know, and nobody knows. But that's kind of lingering in the back of my head too, because why not just kind of save this great news that they just, let out? Why not deploy that during earnings, right? Why say anything at all before earnings? Why not just say that in the earnings report and then come Wednesday morning, let the stock skyrocket then? It just doesn't add up. I don't know what I'm missing here. But my strategy right now, or what my goal is I've always liked AMD as a company and as a stock, if you've seen my videos, going back past few weeks and months. So I do want to own shares of AMD, and I would love to sell the wheel on them. And by that, I mean own shares and then sell covered calls on them as hopefully AMD stock rises over time. Now, if I can get into AMD, because I'm very bullish on them long term, I would love to get assigned shares of AMD at a low price or at a low cost basis, and then I can hold the shares long term while selling covered calls on them along the way. So not only do I gain stock appreciation if I hopefully own AMD over the past, over the next coming months and years and decades, but I can also collect premium and get cash flow along the way as well. So that's kind of my perfect world plan, is to get assigned shares of AMD at a quote unquote low price, hold it long term, and then sell covered calls on it along the way to basically get a little bit of money in my bank account every week or every month. And also, at the end of the day, if I had just bought and hold the stock, if I collect premiums along the way, well, then I'm overall more profitable than if I just bought and hold the shares. So that's kind of my long-term play. But because of this huge run-up the past 2 days, AMD is a little bit more pricey than it was just a few days ago. So the way I'm thinking about playing earnings is to sell far out of the money cash secured puts. Because I believe, and this is just my opinion, I think that AMD no matter what their earnings says, even if it's good or even if it's bad, I personally think that the AMD stock price is going to go down, because I can't imagine AMD running up 25% prior to earnings and then them having good earnings or good numbers, and then it runs up another 10, 15, 20, 25%, right? That just seems crazy to me. I can't foresee any stock running up like 50% in the matter of a week. But the real question then is, well, how do I play my hypothesis, or how do I play that strategy if I think that AMD is, best case scenario, going to trade sideways, or if I think it's going to drop and drop significantly? Well, if that's the case, if we look at the options chain, my kind of thought process right now, because ultimately my goal is to get assigned shares of stock at a low price, would be to sell a relatively far out of the money cash secured put. So if you saw my video from yesterday, actually, you can see I did a little bit of calculation, just quick and dirty, to see what the return on risk was at various strike points. So if I really want to get assigned shares, I mean, $55 would be a dream right now, given that it was around 55 a few days ago and now it's run up. Now, if I think, we're going to give all that profit back from profit taking or sector rotation or whatever you think, I could sell cash secured puts at the $55 strike price and still collect 0.4% return on my risk, which again is not bad at all. I mean, just to do that math again, that would be $22 here divided by a collateral of $5,500, and that should be pretty much, exactly 0.4%. So I could do that, right? I could sell, I don't know, maybe 2 or 3 of these contracts, collect, let's say $44 or $66 roughly, and if I do end up getting assigned shares of AMD, I'm fine with that because it's much cheaper. It's $15 cheaper than where it's trading at currently. So I basically would have got assigned shares of AMD on sale. Or if you don't want to get assigned shares and you want to think about it that way, you can say, well, I'm so far out of the money that I don't think AMD is going to drop $15 in the matter of, let's say, 3 trading days, right? Because earnings are Tuesday after hours. So you only have Wednesday, Thursday, Friday before the weekly option would expire. So you could say, I don't think AMD is going to drop $15 in 3 trading days. So I'm going to select this strike price because I think I'm not going to get tested and I'm not going to get assigned shares, and I'll collect 0.4% return on my risk, quote unquote risk free, or with less risk than it would usually be. But then I got to thinking was, well, what if AMD does go up a little bit, even more after earnings, right? How can I capture that, or am I able to collect more premiums? And one thing you could do is what's called a Jade lizard. And I've never played this before, and I'm still learning about it. So if any of you have actually used a Jade lizard strategy, leave it in the comments below and let me know how it's going, or post in our Discord about it. But what a Jade lizard basically is you're going to sell a put. So, I mean, it could be a naked put, but this is Theta gang, so I like cash secured puts. So you're going to end up selling a put, and then on the opposite end, meaning above the stock price, you're going to sell a call spread that would then be out of the money. So to give you an example of a Jade lizard or what that would entail, I'm just going to write Jade lizard in green here because Jade, right? And lizard. But let's just take a quick look at what that would entail. So what that would mean was, let's just say for argument's sake, I pick that $55 strike price again for my put. So let's say I want to sell a 55 strike put. So I'm going to write $55, right? Because that's my strike for my put. And I'm just going to write put here. And so that's going to tie up $5,500 of my collateral. And then how much money would I collect in premium? We already said that was $22. So I'm going to just write $22 here on the side. So that's the total premium that I get for selling that put. So if I did not do anything else and I just sold this cash secured put, then my max profit would be $22 for that week. if I don't get assigned shares, right? But let's say you want to collect a little bit more premium. So that's where the Jade Lizard comes into play. And what you can do is you can sell a call spread that's above the stock price. And now, the other way to play this would be a strangle, where you sell a put and you sell a call. But because I currently don't own any shares of AMD, although it would be a cash secured put, it would not be a covered call because I don't own shares of AMD. It would essentially be cash covered, meaning that money would come out of my account because I don't own any shares. Now, if I had already owned 100 shares of AMD, then for sure I would have sold a cash secured put on the downside and then sold the covered call out of the money on the upside. That way I have a range of where I would need the stock to be. So for example, let's say for a strangle, I could have sold the put at 55 and then I could have sold a covered call at, let's just say, 75, for example. So that means I would collect the premium for the 75 covered call, which would be, in this case, 196. The premium for the put, which would be $22 right here. And then I would need the stock price for AMD to be between those two strikes. So in this example, I would need it to stay between 55 and 75 for me to get max profit on both options. Now, because I don't own any shares and I don't want to open up a naked call, I can open up a call spread. So what that would mean is that I would pick two strike prices and I would personally pick them $1 width apart, because the difference in your spread in terms of the strike prices is going to be your max loss. So for example, let's say I wanted some protection to the upside, or I wanted to take advantage of premium if stock went up. Because by selling a 55 strike put, if AMD closes end of day on Friday, July 31st, if it closes at $55.01, or if it closes at $155, my max profit would not change. No matter what price the stock closes at, as long as it's above $55, my max profit is capped at $22. So let's say, you know what? If AMD does rise a little bit, like let's say it goes to $70, or let's say it goes to $75 after earnings, and then end of day Friday it closes at $75, how can I take advantage of that to collect a little bit more premium? Well, like I said, one way to do it is with this Jade Lizard. And in general, this Jade Lizard is a neutral to slightly bullish strategy. So, for example, if I wanted to be far out of the money because I want to leave myself a decent buffer, but I don't want the stock price to blow past my call spread here. So let's just say I do a call spread at $80, right? Because I don't think AMD, even if it beats earnings, I don't think it's going to jump up another $11 in the matter of 3 trading days. So I could sell a 80.79 strike call spread. So what that means is you're going to end up selling the lower strike. So you're going to sell the $79 strike here. So that means you're going to collect $111. So I'm just going to write that here at the bottom. So you're going to collect $111 by selling the 79 strike call here. I'm going to make this a little bit neater and just keep it consistent with what we did before. So let's just say we're going to keep it at $79 strike. And this is going to be the call that we're going to sell. And then that is going to net me $111 in premium, right? Because I'm selling this call. And then what you're going to do is you're going to end up buying the strike above it. So you're going to buy the $80 call. So the 80 strike call, you're going to buy that, and that's going to complete your call spread. But because we're buying it, and I'm just going to switch tabs here, you're going to end up paying $80, or sorry, $99, right? Because we're buying this option and we're only selling this option. So that means we're going to have to subtract $99, right? So at the end of the day, what are you left with? So if we add up our premiums, we're going to gain $22, right, from selling the cash secured put. We're going to gain $111 by selling the $79 call, which if we stop there would be a naked call. But to not make it a naked call and make it a call spread, we're going to now buy the $80 call option, and for that we're going to pay $99. So I'm going to subtract $99. So now we are left with a total of $34 in premium. So if we before had just opened up a cash secured put, your max profit is only $22. But by now adding a call spread to the upside, you're able to increase your max profit by $12 per contract, right? So the way to collect max profit in this Jade Lizard is that you would need AMD to close above your put. So you need to close above $55. So I'm just going to put that in yellow here. You're going to need it to stay between $55, and then you need it to close in terms of the high side below $79. So as long as AMD closes between $55 and $79 on end of day Friday, July 31st, you will collect your max profit of $34 now. So now what is your risk, or what is the max loss, or what's the worst case scenario with this strategy? Let me delete some of this off the screen so it's easier to read. So your risk here is, let's say AMD just plummets, and let's say it just goes to $40, right? Just for an example. Well, that means that your call spread is going to stay out of the money. So you're going to collect that as profit. You're going to collect the difference of 111 minus 99. So you're going to collect $12 in profit. And I'm just going to write that in, maybe we'll do light gray here, just so the difference here is $12 of profit, right? So if AMD just absolutely tanks and goes to, let's say, $40, this call spread will expire worthless. So you'll make your $12 in profit. You'll get to keep that. However, because AMD closed below your put, you're going to get assigned shares of AMD at your strike price. So you're going to get assigned shares of AMD at $55. So worst case scenario, if AMD drops, if it drops below your put, that means you collect whatever profit you collected from your call spread, but now you're going to get assigned shares of stock unless you decide to roll your put option out. Now, what happens if AMD just absolutely goes to the moon and goes to 100? Let's say it blows past your call spread. Well, you'll never get assigned shares of stock, obviously, right? If it blows past your call spread. And because you have a spread, your max loss is just going to be the difference in your strike prices. So because we have a $1 with spread here, right, between $79 and $80, the difference is only $1 per share times 100 shares. So that means your max loss on the upside is going to be $100 if it blows past your call spread. So if AMD goes to $100, well, I'm gonna lose $100. Just to make it not confusing, let's just say AMD goes to 90. The AMD stock price is 90. I'm gonna lose $100 from my call spread because, again, that's the difference between the strikes. However, that means then my put expired worthless. So I would actually get to keep my full max profit on my put side. So although I would lose $100 on my call spread, I would gain $22 from my put expiring worthless. So at the end of the day, I would have only lost $78, right? I mean, obviously the goal is not to lose any money, but this is a way where you can increase your max profit by assuming a little bit more risk. Now, the great way to play it, and I'm sure a lot of my viewers are just itching at the keyboard to type this in the comments, is you want to be able to somewhat offset these differences. Meaning, these strikes I chose without thinking, I just chose randomly. But if you can make it so that the credit you collect from your put option is very close to your max loss on the call spread, then you could, in theory, make it out so that you would break even if AMD were to just shoot up to, let's say, $300 or just go to the moon, right? So if I wasn't comfortable with a max nominal loss of $78, I could increase my put price or my strike price for my put to get it close to $100 because that's the width of my strikes. So let's just look at the options chain. So here's a $62 put that would give me $102 in credit. So what I could do is I could change this to eraser, and I could make this into $102 I would collect. And instead of 55, we're going to collect, or not collect, we're going to use the $62 put, right? Because the 62 strike put here gets me $102 in premium. So now, if we just do a little quick recalculation, so now my max profit is $102 plus $111 for selling the 79 call minus $99 for buying the 80 call. So now my max profit is $114. And then if we were to redo this calculation, my max loss in this scenario, aside from possibly getting assigned shares if it drops to below your put, your max loss to the upside if AMD just blasts past your call spread, let's say it's again a $1 wide call spread, so it's $100 minus your premium that you would collect, because if it blasts to the upside, your put is going to expire worthless, so you'll collect max profit on that end. So actually you collected $102 in premium for the put side, and you only lost $100 on the upside. So actually you would still come out positive $2 because you lost $100, but you got $102 from your cash secured put expiring worthless. So really, in this scenario, you're collecting a higher potential max profit of 114. Your max loss to the upside is actually not really a loss at all. It's $2. Your max loss to the downside would be getting assigned shares of stock at the $62 price. So in this example, compared to the one I showed you earlier, the only difference is you have a narrower gap between your put side and your call spread. Because before we used the 55 strike put, and we said that you would get your max profit, which was significantly lower than 114, if AMD closed between 55 and 79. If we narrow that range a little bit to 62 and 79, your max profit is almost 5 times higher, actually more like 3 times higher, and your max loss to the upside is actually still profitable instead of you being in the negative. So this is a Jade Lizard. It's actually a pretty interesting strategy. Check with your broker, because most brokers have the spreads as a very high level of options trading. So you may or may not have spreads enabled on your account depending on which broker you use and what level of options trader you are. So just double check with that before you try and open a Jade Lizard. But it's actually a very interesting strategy. And maybe I will play it out. I'm not sure, because I don't want to limit some of my capital to the call spread side. And maybe I'll just open up, instead of one contract at a cash secured put, I would open up, let's say 2 or 3 maybe. I'm still thinking about this, mulling it over. Like I said, I've never played a Jade Lizard before, and I'm still learning about it. So if any of you have any more experience with it, please leave it in the comments below. Let me know what you think. Let me know what your experiences have been so far with it. And As always, join us in our Discord server. We have about 100 plus members already. A lot of good discussions going on in there. And as always, happy trading.